Because this week, this week, we've got quite a lot of work to do. You start with your official mid-semester test week next week. You are writing now the first class test on the 15th of April and not as indicated on your work program on the 14th. The 15th of April, that is according to the university's mid-semester assessment week timetable, and we have to keep to that. The awful thing about the 15th of April is that we are only scheduled to write at 3 o'clock. We start writing at 3 o'clock the afternoon. It will be a 90 minutes test, so it's quite a big test. And then you will have 20 minutes for upload, scan, and email. Now, for the purpose of that that class test, which is quite a big test, I am going to take in a homework question by way of an upload on Thursday so that we can actually practice this whole process before next week when you have to submit your test, because there will be no exceptions in the test, no late submissions will be accepted, etc., etc. So on Thursday, we will have an upload of your homework questions on Ifundi. I will give you further particulars during the course of the week. Good. Then about last week's work, guys, I see that there's quite a lot of students that decided not to write the last Ifundi test, which was actually the most important one of them all. Now, look, it is your story if you don't write it, but I can promise you that, and you can go and ask for second-year students, that your participation mark very often was, or you were sort of saved by the Ifundi quizzes in order to get enough marks for participation purposes, and then at the end of the day, it also had an impact on your final mark. I will definitely not recommend that you miss any Ifundi quizzes. It's easy questions. You can have a good mark for that, and that actually boosts your participation mark quite considerably. I had somebody who put, I don't know whether it was on the group, whatever, but she sent, or he, I don't know whether it's he or she, a WhatsApp message this morning, must we work through the videos? My goodness gracious, why would I go through the trouble in doing the videos? The videos replaces your formal class time. This Zoom session is just to touch base with you. It's not for lecture purposes. I'm going to do VAT today, but it is because VAT is quite complicated and I know students battle with VAT, and that is why I'm putting an extra session in only on that. But for the rest, I'm not going to do with you. I've done it on the video as if you were sitting in the class. So if you're not going to work through the videos, guys, you're not going to make that. That is a fact of life, because that is the same thing as not attending class. If you're only going to look at the answers of those questions, you're either not going to make it either. Because I only use the question to explain what this whole study unit is all about. So you have to watch the videos at least once. The only reason why I put the answer or the solution for that question on Ifundi as well is because you don't have time before a test or exam to watch all the videos. It is impossible. Then you only want to focus on answers or stuff that you battled with. But at least once, for the first time that you're going to look at a question or at an answer of a question, you have to watch the video, because I talk not only about that question, I also tell you about other information, things that possibly can be asked in a test or exam, etc., etc. So this is the last time that I'm going to tell you to watch the videos. If you don't want to watch it, well, then just bear the consequences. I don't care. Okay. Now, this week's work is actually built upon last week's work, but it is on a more complicated level. So, guys, you are also writing next week's test up to the end of this week's work. So this week's work is extremely important for the purposes of the test, because we take it up to a slightly higher level, and you're not going to get low-level stuff in any test that you're going to write this year. Great. Next week, because the test week officially starts on Wednesday, the 14th of April, I will have a combined Zoom session once more on Tuesday afternoon for the English and Afrikaans guys, because they obviously going to miss out on a Zoom meeting. But next week, I'm only going to focus on answers and questions. So you will have to prepare all your answers, all your questions for next week's session, and then we will go through that during the session. Okay. What I would like to do, is there any questions up till now from any person?
Middag mevrou, ek is deur Jamie Breins gevra om die sessie te record.
Ja.
En sy het vir my gesê, ek moet Philip Nolte, ek moet by mevrou toestemming vra of ek hierdie sessie kan record.
Ek het klaar vir jou toestemming gegee. Jy behoort die funksionaliteit te hê, hoor.
Baie dankie mevrou.
Okay. All right, guys. Any other questions? Great. Then I'm going to move to our the VAT session. Now, you have to work through all the stuff that I gave you, all those slides, all those videos on those slides for today's session. Otherwise, you're not in any case going to understand much what I have to say. Let me just find this thing. Can you see it on the screen?
We can see it, ma'am.
Okay, thanks. Right, let's talk about VAT. VAT is that animal that's with us, that we cannot get rid of, that all of us is actually, we have to pay that on a daily basis on basically everything that we buy. And now what is VAT all about out of an accounting perspective? Now, what I've said is that I know that students are battling with VAT, and the reason why they mainly battle with that because they don't really read what the question tells them. So today I just want to talk about VAT. What is VAT? When is VAT coming into play? And how do we treat VAT in the accounting records? Now, we know that VAT is an abbreviation for value-added tax. So in that video that I have on VAT, I tell you exactly how VAT works. So go and have a look at that to see that you understand what VAT is all about and how VAT is working. Now, VAT is included in every item that you purchase. So if you go and have a look at any slip, any invoice, anything that you're going to buy, somewhere on that slip or invoice, you're going to find something that they call VAT. So whenever we buy 99% of goods in this country, we have to pay 15% VAT over and above the purchase price of an item. Also, if I'm an entity and I'm going to, oops, I don't want to do this, and I'm going to sell something, I have to add 15% to my selling price in order to get the invoice price. So the total sales value of an item will include 15% VAT. Now, what is extremely important is that you must understand that VAT is something that belongs to SARS. The only reason why a company or entity or business is involved in this whole VAT story is because that entity is actually acting as an agent of SARS. So if I sell an item, I have to raise VAT, and then I collect the VAT, and I have to pay over that VAT that I've collected to SARS. So the amount that I collected, the VAT portion of my selling price, does not belong to me, does not belong to the entity, does not belong to the business. That 15% that he collected over and above the actual selling price of an item, that belongs to SARS. He collects it on behalf of SARS, but then at the end of the VAT period, he has to pay it over to SARS. It is important that you understand that the VAT period for medium-sized and small-sized entities is only a 2-month period. A VAT period for a larger entity is on a monthly basis. So I accumulate all the so-called VAT that I raise on behalf of SARS and collect on behalf of SARS. We call it output VAT. And then I can claim that input, which is applicable on all the stuff that I've purchased. So when the entity buys something, he's going to buy it at X amount, but then he's obliged to pay 15% VAT on the purchase price. Now, the receiver of revenue says you can now claim that amounts that you've paid for VAT against the amounts that you've collected on my behalf. And then at the end of the VAT period, being it a 1 month or 2 month period, you pay to me the net VAT that you have collected. So in other words, the VAT that's more that you collected than the VAT you can claim, you pay it over to me. And in the exceptional circumstances where you actually claim more VAT than the claim that you've collected, i.e. the VAT that you've paid on items that you've purchased is more than the VAT that you've collected on the items that you've sold, then the receiver of revenue has to pay you that outstanding, the net amount of the VAT input. But it's very important that you understand that the entity acts as an agent. What does it mean in plain, simple English? It means that the VAT is never equal to the, it never belongs to the entity. VAT is the receiver of revenue. The entity is just the guy who's doing the collection work. Now, what does that mean? That means that no income or expense item of an entity can ever include VAT because the VAT is not his. Any normal asset should not include VAT. Now, we'll talk about that a little bit more. Now, when do we talk about VAT? When does VAT come into play? Now, the first thing that needs to happen is that the company or the entity or the business that you're working with must be registered for VAT. When they are registered for VAT, we call them a VAT vendor. And there's a threshold where once your turnover exceeds that threshold, you have to be registered. So the first thing is for VAT to be recorded in your books, you have to be a registered VAT vendor. Here again, you can claim then, once you are a VAT vendor, only then you can claim input VAT on all expenses, which included VAT that you had to pay. And you have to pay output VAT to SARS on all the income and all the VAT that you've levied on those items that you have received the money from. Now, when does an entity pay VAT? Number one, when he is a registered VAT vendor. That is the first requirement for everything. Now, VAT is raisable or payable. Let's say we talk about pay, yeah? To who do we pay to? We pay the VAT over to SARS. Now, if we're going to pay, it will be on all income that we have earned. Listen to the word earned. So the receiver of revenue is also on the accrual basis. He also recognizes the accrual basis as a basis for you to operate on. And then he says, once you have raised a VAT invoice, let's say that we've made a credit sale. What is our entry in our books? We debit debtors, we credit sales. So it says, I haven't received the money I said. This doesn't matter. You have issued a tax invoice. Now go and have a look in your slides and in the video on VAT. What is the requirements on a VAT invoice? Because that is also very important. If I do not meet the requirements of a VAT invoice, I'm not allowed to claim VAT. And on the income side, if I still pay over the VAT that I've raised on behalf of the receiver of revenue, but my tax invoices do not adhere to the requirements set by him, he can raise penalties and interest from me as a result of that. And it's severe penalties and interest, guys. I also mentioned to you in that video that the bank that I used to work with, they have levied us with a 40 million rand interest and penalty because our tax invoices did not meet the correct requirements. So it's extremely important. So it's all about income earned. Now, examples of that is all our sales revenue. We have to add that to our selling price, and that portion that we're going to add, we're going to pay it over to the receiver of revenue. Whenever we're going to dispose of any of our assets, let's say we're going to sell a delivery vehicle, and we're going to receive something for that delivery vehicle, the proceeds on the disposal of that delivery vehicle, included in that is 15%, which belongs to SARS. Why? Because SARS, we're going to do the input VAT now, but SARS tell us that whenever we bought the delivery vehicle, we could have claimed the VAT. He says, but then the same thing applies when you sell the vehicle. Whatever you're going to get for that vehicle, you have to give me 15% of that amount, because that is the VAT on the amount that you've received. So what is now something that we call standard rated items? And go to your video and the slides on that again. About 99% of items are standard rated items, and a standard rated item is an item that attracts 15% VAT. But then you also get something like an exempt item. And the exempt item, there is no VAT applicable on an exempt item. Examples for that, when we talk about when we have to pay the receiver VAT, it will be on income that we earn. So income like interest received, that is exempt from VAT. So it's important that you understand that and important that you know that, because your accounting entries that you're going to pass will definitely test whether you know that or whether you don't know that. Now, over and above a standard rated income item and an exempt income item, I also get a zero rated income item. Now, a zero rated income item says there is VAT applicable on this item, but it is at a zero rate. Now, whenever you're going to do VAT in income tax next year, you will see that that is quite important, because that means I can claim the VAT on expenses that I've incurred in order to generate any taxable supplies. Now, a taxable supply is something that attracts VAT, even if the VAT rate is zero. So it is important that you know that there's quite a distinction between an exempt rated item and a zero rated item. What is important about a zero rated item is that there is no items, there's no VAT on those items. Now, an example for an income item, i.e. an item that we have to collect VAT on behalf of the receiver of revenue, is all sales revenue that we're going to receive or earn from exports. So once we export an item and then receive income on that, that is not subject to value-added tax in this country. Why not? Because the guy who's going to pay for that item is someone, let's say, that sits in Germany. He's got absolutely nothing to do with our tax system, so he is not liable for any taxes in this country. So therefore, that revenue earned on exports, items that we export and earn revenue from outside sources out of the country, that is not subject to VAT either, but that is a zero-rated item. When do we claim VAT? Now, we pay VAT and we call that output tax. We claim VAT and that we call input tax. And go and have a look at the video again. I explained that in more detail there as well. When can we claim VAT? Number one, we must be a VAT vendor. If you're not a VAT vendor, you cannot claim anything. And then, hand in hand to that one, and that is only when we claim VAT, is we claim VAT on expenses incurred. And that means that we need to receive a VAT invoice from the party who we are going to buy from. And it is only a VAT vendor that can issue an invoice. So we must be a registered VAT vendor and we must buy something from another VAT registered vendor, because it's only then that he can issue a VAT invoice to us, and it's only when we can receive a VAT invoice that we can claim VAT. So input VAT, when can we claim VAT back from the receiver of revenue? Number one, I must be registered, and number two, the counterparty with whom I've transacted with must also be a registered VAT vendor. We can claim VAT on all standard rated expenses incurred or paid. So I'm going to give you an example of both a little bit later on, but it is a standard rated item. So about 99% of all expenses are standard rated items. So it attracts VAT. The only items that's not standard rated is exempt items and zero rated items. So therefore, again, you must know what items is exempt items. Now, interest paid, finance costs, guys, that is not subject to VAT. Another exempt item is, for instance, if I pay an insurance premium on the life of somebody, so long-term insurance, that is exempt. But short-term insurance premiums is subject to 15% VAT. So whenever an entity is paying insurance, let's say on its vehicles, or whatever is going to insure, there is VAT applicable on short-term insurance. It's only when the life, let's say, of the owner of that entity has been insured, that premium on the life of the owner, that will not attract any VAT because that is insurance that is exempt from VAT. Salaries and wages, that's an exempt item. There's no VAT applicable on salaries and wages. Now, simultaneously, there's no VAT applicable. Well, you cannot claim any VAT on staff-related expenses. Now, what do I mean by this? Let's say that the entity has a staff room. In the staff room, they have now bought a fridge and a microwave oven for the staff members to use during their lunch times or whatever. Now, obviously, if this entity is going to buy the microwave oven and the fridge, they're going to be issued with a VAT invoice. Let's say they go and buy it from GAME. GAME is going to give them a VAT invoice for that. So I'm a VAT vendor and GAME is a VAT vendor. But the receiver of revenue said, why did you buy the fridge and why did you buy the microwave oven? I'm telling him it's for my staff to use during their lunch breaks. He says, well, that's very nice of you. Thank you very much. But you are not allowed to claim that VAT for VAT purposes. So any staff-related expenses that you're going to incur, you are not allowed to claim the VAT on those kind of expenses. I buy table and chairs for the staff room. I buy that from whoever, Bradlow's. Bradlow's is a VAT vendor, I'm a VAT vendor. The receiver of revenue says, for what are you going to use those tables and chairs? So I'm going to put it in my staff room. He says, well, sorry, then you can't claim the VAT. You know, telling me, but I've bought now office furniture, office desk and chairs for my staff, my admin staff. And he says, well, that's very nice of you. You can claim the VAT on that because those furniture, your staff needs to sit somewhere and do their work. And by doing their work, they're going to earn revenue for you. So you are allowed to claim the VAT on office furniture and equipment, but not on anything that you're going to use in your staff room. So that's an important classification. Make sure that you understand that and that you've made a note of it somewhere because I don't think it stands anywhere else. So make notes. That is why you have to attend these Zoom sessions, and if you're not, you're going to fall short. What is depreciation, guys? Is that a standard rated item, an exempt item, or zero rated item? Depreciation is none of those three. What is depreciation? Depreciation is where I allocate the cost price of a non-current assets to my income statement to reflect the usage of that asset in the current financial period. Now, it's the cost price of the asset. When I recorded the cost price of the item, that excluded VAT if I'm a VAT vendor and I bought from another VAT vendor because I'm allowed to claim the VAT on whatever the non-current asset was that I initially bought. Let's say I bought a machine, I'm generating income out of the machine. At the end of the financial period, I'm going to provide depreciation on that machine that I've used. Now, how do we provide depreciation? We provide it on the cost price of the asset. The cost price of the asset is VAT exclusive. So depreciation is a book entry where I write off a portion of that cost price, so there's no VAT applicable on that whatsoever. The VAT was applicable when I purchased that machine. When I purchased that machine, I claimed the VAT. When I'm going to sell that machine one day, I have to pay over, out of that proceeds I'm going to receive, I have to pay over 15% to the receiver of revenue because then I am subject to VAT. But depreciation is just the allocation of cost to my income statement, so there is no VAT applicable on that. The zero-rated items, which there is again no VAT that you can claim, is things if I buy zero-rated food stuff. I don't know, let's say that I am a restaurant and I buy fresh fruit and veg for my restaurant. And I'm going to pay food on that. Mute yourself, please. I'm going to buy that from a restaurant, for my restaurant. There will be no VAT applicable on those potatoes and fresh fruit and veggies or whatever I'm going to buy. Therefore, I cannot claim anything. Okay. Road and rail transport. Let's say that I have to pay somebody. I'm going to put my, I've got a number of branches through the country. And I put my finance manager on a bus and I say, now you're going to travel to Cape Town, you're going to see that everything is fine at our branch in Cape Town, and you're going to travel by bus. Here's your Greyhound to Intercape ticket, and there you go. There is no VAT on road or bus transport. Excuse me. But whenever you're going to book your finance manager on an aeroplane and say, now you're going to fly down to Cape Town, included in that ticket, that flying ticket, there is VAT applicable on that. So road and rail transport, there's no VAT applicable on that, but once you get on the aeroplane, there is VAT that you have to pay. Fuel, we are in for a huge fuel increase tonight. There is no VAT on fuel, guys, but there are hundreds of other levies, as we know, on fuel. So although there's not VAT on fuel, there are other levies. So because it's not VAT, you cannot claim it back from any person or anybody or source or anything. You just have to pay it and shut up and just bear the brunt. Okay, now how does that work? SARS works with two scenarios. He says, first and foremost, the most important thing is the tax invoice. If you have been issued with a tax invoice, or if you have issued a tax invoice, whatever the VAT is that appears on that tax invoice is either payable to me, if it's on a sales transaction, then it's output VAT, or you can claim the VAT if you've purchased something and you have a tax invoice, you can purchase the VAT that appears on that VAT invoice. He says, so the tax invoice is the most important thing. You see, but he says, in a case where no tax invoices has been issued as yet, so eventually there must be a tax invoice. But let's say at the end of the month, at the end of your VAT period, or at the end of the financial year, no VAT invoice has been issued yet. He says, okay, well, I hear you, you don't have a VAT invoice. My second question is, did cash flow take place? And if the answer is yes, cash flow has already taken place, but I still don't have a VAT invoice, then he says, then there's VAT applicable based on the cash flow that has already taken place. So I'm going to repeat this again. There are two tests that you have to perform when you want to claim VAT or when you have to pay over VAT. The first test is, was there a tax invoice? If the answer is yes, then it's easy. Then whatever the tax was that appeared on the tax invoice, the VAT that appeared on the tax invoice, you can either claim that VAT if you paid something, or you have to pay over that VAT you receive of revenue if you have received money from whatever party. So that's the first test. The second test, he says, is, was there a tax invoice? The answer is no, there was no tax invoice as yet. Then he says, okay, well, now the next question I want to ask you, has cash flow taken place already? If the answer on that is yes, then you have to take the VAT based on the cash flow that has taken place, and you can either claim it if you've paid out an amount of money, or you have to pay over the VAT to him if you received an amount of money. But he says then, at the end of the day, you have to go back and you have to get a tax invoice. But in the meantime, that will be applicable based on the cash flow that took place. Very important. Now, what type of things are important in questions that we're going to ask you? Now, if you work with a VAT vendor, you have to remember the following 4 bullets. That is crucial. I'm not going to tell you the amount includes VAT or excludes VAT. You must know that yourself. And there are a few hints in the sentence that will tell you whether the amount includes or excludes VAT. If I tell you that the invoice price of an item was X, then that means that that amount that I'm giving you includes VAT. So an invoice price of an item will always include VAT. If I tell you that the listed price of an item was Y, you must know that listed prices always include VAT. What is a listed price? Guys, whenever an entity, especially a fairly large entity with a number of items that he sells, he has a computer program on which all these items that is for sale is listed on. And a price per item is connected to that specific item. And that price is the listed price of the item which is available to be sold by this entity. So a listed price, it's a list of items that they have, and with that list of the items, the price per item also appears. And that price per item will always include VAT. The shelf price of an item includes VAT. What is a shelf price? When I walk through Hi-Fi Corporation and I want to buy myself a new laptop, and I look at that little price tag that appears on the shelf where these laptops are actually on display, there's a price indicated on that little tag. That tag must be very clear, and if it's not specifically saying amount, let's say 10,000 plus 150 Rand VAT equals 1,150 Rand, then it means that the price that's on display there is a price that will include VAT. So a shelf price must always be VAT inclusive. You will see that there, it's important. If I quote a price to a customer, that quoted price will always, must always be VAT inclusive. Now, you can quote the price as this item that I'm going to sell to you, the price of this item is 1,000 Rand plus 15% VAT. That is allowable. But then basically what are you telling him? That the quoted price is 1,150 Rand. So invoice prices, listed prices, shelf prices, and quoted prices must always be VAT inclusive. That is something that is dictated by law, guys. It's not something that the entity can decide. Now, what about transactions that we're going to record? Let's start with cash receipts. What happens with cash receipts? Now, for all items, standard rated items, all cash received will always be VAT inclusive. Now, what items will not be VAT inclusive? Exempt and zero rated items. So if I receive those kind of monies, it will not be VAT. There's no VAT on it, so it can't include VAT. Now, I'm asking you a question. Now, if I give you the subsidiary journal, and now think about all the columns of the subsidiary journal, and we talk about cash receipts, so the cash book receipt journal. Sorry. That bank column in the cash book receipts journal, will that bank column always be a VAT inclusive column? The answer is yes, except for items included there, so receipts, which is specifically exempt or zero rated items. Good. Obviously, my cash book receipts journal will now have an additional column, VAT output. VAT outputs on amounts that we receive, so we have to pay over the receipt, that VAT portion to the receiver of revenue. So there's an additional column in your subsidiary journal. Please make sure that you know how your subsidiary journal is now downcasted and crosscasted to make provision for VAT. What about cash paid? Does that always include VAT? Now, cash paid, that is our cash book payments journal. And here the answer is exactly the same. Yes, except for items that we're going to pay, which is either zero rated items or exempt items from VAT. But all other items, all the amounts that we're going to pay will then include VAT. So 99% of all items are standard rated items. So when we're going to pay something, that will include VAT. And then I also then ask you this question. Does this bank column always include VAT? And what is the answer there? The bank column in the cash book payments journal will always include VAT, except if there was a receipt for a zero rated item. Now, I can't see what's happening here. I'll try to move this thing to our side. What about any items where cash or credit invoices was issued? Will that always include VAT? When will I issue a cash invoice? I will issue a cash invoice when it is cash sales that take place. When will I issue a credit invoice? I will issue a credit invoice if there's a credit sale. In what subsidiary journal does cash sales appear? In cash book receipts journal. In what subsidiary journal does credit invoices appear? In the debtors journal. So now it's suddenly very, very important that you know the layout of the cash book payments journal as well as the debtors journal and the debtors allowances journal for that matter. How does VAT has an impact on that? Because in each one of them, I have an additional column now, VAT. Again, very important that you understand the downcasting and the crosscasting and the booking of transactions at month end when there's VAT involved in my subsidiary journals. Now, what do we record in our debtors control account? We record in our debtors control account all credit sales, less all amounts received from debtors up to date. So what is the outstanding balance on the debtors control account equates to? It equates to the sales invoice prices inclusive of VAT. Inclusive of VAT. That was still outstanding at the end of the financial period that you are working with. So if you're working with a current financial month, it will be the month-end balance. Month-end balance of the debtors control account will equal the outstanding credit invoices that hasn't been paid as yet. What does the debtor owe me? The debtor owes me the full invoice amount. Does the invoice amount include VAT? Yeah, Bokoko. The invoice amount includes VAT always. So is the debtors control account balance, is there VAT included in that balance? For sure, there's VAT included in that balance because he has to pay me the VAT. Right. When do I pay over the output VAT to the receiver of revenue? When I raised the tax invoice. When did I raise the tax invoice? When I made the credit sales transaction. Not when the debtor paid me. When I made the credit sale. When I raised the tax invoice, I said debit debtors, credit sales, and now credit VAT output account. At that stage, VAT was recorded in my books at the date when the transaction initially took place. So my debtors control account, that balance will always be a VAT inclusive amount. Now, what about payments made by debtors? Obviously, you must pay me the full invoice amount. So obviously, the amounts I'm going to receive from the debtor will be a VAT inclusive amount. Now, the very same thing applies to the creditors control account. What does the creditors control account balance represent? That represents the value of the tax invoices received from suppliers when I bought something on credit, less any payments that I've already made to that supplier. So that's my outstanding balance. Does that include that? Yes. Why? Because I also have to pay over the VAT on that tax invoice received from the supplier to the supplier. I owe him that money. When did we account for VAT? When we talk about creditors, we accounted for VAT when we made the purchase transaction. What was my credit purchase transaction? I debited purchases or inventory, depending whether it's a perpetual or periodic inventory system. I debited VAT input because I can claim the VAT now, and I credit creditors with a full invoice amount. Payments made to creditors, does that include VAT? Yeah, for sure. Very, very important that you understand this, guys, and understand the impact of VAT also on the creditors journal and the creditors allowances journal. Now, what about financial statements? Now, the statement of profit or loss and other comprehensive income, what do we record in that statement? Income and expenses. Income will be net of VAT because we have to pay over the VAT portion of what we receive to the receipt of revenue. So what do we retain? The VAT exclusive portion. Expenses. What do we record in our income statement as expenses? Only the VAT exclusive amount. Why? Because we've already claimed the VAT from the receipt of revenue. So extremely important. And you have to say this at least 10 times loud to yourself. No income or expense item will ever in your life include VAT. So no item in the statement of profit or loss and other comprehensive income will have any VAT included in that item. Now, what about our statement of financial position? Now, in that statement, we have assets, we have equity, and we have liabilities. Let's talk about assets. Bank and cash. Yeah, when we receive and pay money, there will be VAT inclusive amounts. Debtors control, we've already said that in our debtors control account, what do we record in that account? The VAT inclusive amounts of the invoices that we've raised, and what are we going to account against that? The amounts received from the debtor, and that will be a VAT inclusive amount as well. Let's just talk about control account for the moment. Equity. No equity item will ever have VAT included in that item. I'm just thinking very quickly that drawings where the owner takes inventory for personal use, you have to raise VAT on that item that it takes, but that is not VAT that you raise on the transaction. That is a reimbursement to source of the original VAT that you claimed when you bought the inventory item. So what happens is when you buy an inventory item, there's VAT applicable on that, and I claim the VAT. So I record my inventory net of VAT. So my inventory figure is always a figure where the VAT has already been removed out of. So now the owner takes that inventory item for personal use. So I have to adjust my inventory account. I can only adjust my inventory account with a cost price VAT exclusive. So I'm going to create my inventory account. Then the receipt of revenue says, wait a minute. When you purchase that inventory, you told me you're going to sell that inventory. I allowed you to claim VAT on that item because when you're going to sell that item, you're going to raise output VAT, which you have to pay over to me. Now you can't sell that item, so you can never raise output VAT on that item. So I want the input VAT back from you that you originally claimed on the purchase transaction when you bought the inventory item. So therefore, if in your drawings, you will then have debit drawings, which that amount will include the cost price of the inventory item plus the VAT on the cost price of the inventory item. So let's say the owner took inventory for personal use amounting to 1,000 Rand VAT exclusive. That was the cost price. I'm going to credit the inventory account with 1,000 Rand to remove the cost price of the inventory item out of the inventory account. I have to get the 15% that I originally claimed on that item back to the receiver of revenue. So I'm going to credit that output with 150 Rand, 15% on 1,000 Rand, the cost price of the inventory. And I'm going to debit drawings with 1,150 Rand. That is a sort of a VAT-related item which is lying in equity, but it is not a VAT item. It is a reimbursement of VAT previously claimed on the inventory. It's all about the inventory and not on the equity. Okay. Liabilities, the creditors control account, we've already seen that that will include VAT. Overdrawn bank accounts, that will come about as a result of transactions which included VAT. And here's the VAT control account again. Now the VAT control account, at the end of the VAT period, all the VAT inputs which was accumulated in the VAT input account, which is an asset account, has to be closed off against the VAT control account. So I will credit the VAT input account, I will debit the VAT control account. All the VAT outputs accumulated for the VAT period, the months or the 2 months period, has to be closed off against at the end of that VAT period to the VAT control account. So I will debit the VAT output account and I will credit the VAT control account. Now, if the balance in the VAT control account at that stage is a credit balance, it is a liability. If the balance in the VAT control account at that stage is a debit balance, it is an asset. When will it be a debit balance? It will be a debit balance if my input VAT was bigger than my output VAT. What does it mean? It means that the VAT that I can claim on expenses is more than the VAT that I have to pay over to the receiver of revenue, which I have received, collected on his behalf on my revenue figures. If I have to receive money back from the receiver of revenue, it's an asset. But the contrary is also true. If my output VAT is higher than my input VAT, my VAT control account will have a credit balance. That means I've collected more VAT than what I can claim. Therefore, for that difference between the two, I have to pay over that VAT to the receiver of revenue. It's a liability, it's an obligation, it is a commitment that I have to honor. I have to pay him the money. Let's do an example of, I think this is an example, guys. I don't know whether you can see that. It's cut off on my screen, but it's an example of prepaid expenses. How does that work when we have prepaid expenses? We pay an annual insurance premium of 13,800 Rand on 1 February 2021. The financial year end is 28 February. And the question is, what accounting entries should we pass? Now, on 1 February, we pay an amount of 13,800 Rand. We've already told each other when we pay something, it will include VAT. So in accounting, the very first step that you take, always, it doesn't matter what type of transaction you do, you remove the VAT. So the VAT included in that payment of 13,800 Rand is 1,800 Rand. How do I get to that? I say 13,800 divided by 1.15 multiplied by 1.15, 15%, 0.15. And that gives us 1,800 Rand. The receiver of revenue says, did cash flow take place? I say yes. He says that you receive a tax invoice. I say no. He says, but it doesn't matter. Did cash flow take place? I say yeah. He says, well, if cash flow took place, you are allowed to claim the VAT. So although this is an annual premium, that actually also, only 1 month of this premium belongs to the current financial period. 11 months belong to the next financial period. But it doesn't matter. He allows you to claim the full 1,800 Rand, because you've paid that amount. You've already, cash flow has already taken place. So what is our accounting entry then on the 1st of February when we made the payment? We are going to credit bank, obviously, statement of financial position with the full amount that we paid, 13,800, that was the cash outflow. We're going to say 13,800 divided by 1.15 gives us 12,000 Rand. And that we took to our expense account in the statement of profit or loss, 12,000 Rand. Then we claim the VAT, so we're going to debit our VAT input account, statement of financial position, with 1,800 Rand. Now come year end, 28 February. We scroll down our trial balance. We pick up, we have insurance expenses there of 12,000 Rand. I ask myself, have I incurred 12,000 Rand worth of insurance expense? I says, no. This was an annual premium. So I've only incurred 1 month worth of premium, which equals 1,000 Rand. So the balance that must stay behind in my expense account must only be 1,000 Rand. So therefore, I'm going to credit my insurance account, my expense account, statement of profit or loss with 11,000 Rand. Then there's only going to be 1,000 Rand left. And I'm going to debit prepaid expenses, statement of financial position, 11,000 Rand. And this one is an asset, guys. It's a current asset, 11,000 Rand. What is the conclusion now? Because cash flow has taken place, I was allowed to claim the full VAT on the full amount that I've paid. So prepaid expenses, which is an asset, will never include VAT. Make a big note of that. Prepaid expenses, because cash flow has taken place, I've already claimed that VAT. So prepaid expenses will never ever in your life include VAT. The next expense is, the next example is on accrued expenses. What happens with accrued expenses? Let's do an example. We received the rates and taxes account for February 2021 on 2 March 2021. The amount on the invoice is 5,750 Rand and was paid on 7 March 2021. The financial year end is 28 February. And the question is, what accounting entries do we have to pass? Now, the first one is at year end. I scroll down my trial balance. I look at my rates and taxes and I say, I only have 11 months worth of rates and taxes. My financial year was 12 months. I've already incurred the expense, but I haven't paid it as yet, but I have to account for it because I have already used those rates and taxes service from the municipality. So therefore, if I want to have faithful representation of financial statements, I have to include that expense in all my total expenses for the current year. So what am I going to do? On 28 February, I'm going to debit my rates and taxes expense account in my statement of profit or loss. With what? The VAT exclusive amount. No income or expense item ever includes VAT. So I have to work back to the VAT exclusive amount of 5,000 Rand. Then I can claim the input VAT on that. So I'm going to debit VAT input statement of financial position, 5,000 times 15%, 750 Rand. And I'm going to credit accrued expenses in my statement of financial position with a full outstanding amount was 5,750 Rand. What is accrued expenses? It's a liability. I owe the municipality that amount. I've already received the benefits of that from the municipality, but I still haven't paid them as at year end. What happens on 7 March? On 7 March, I actually go and I pay the municipality. So then I'm going to debit accrued expenses, statement of financial position, and I'm going to credit bank, statement of financial position, 5,750 Rand. Conclusion. Expenses never includes VAT, but accrued expenses include VAT. I owe I claimed that I owe the municipality the full amount, and I've already claimed the VAT from the receiver of revenue. Good. Now, what about income received in advance? Income received in advance. What happened there? Just before we go to the example, I have received the money as yet. The receiver of revenue asks, is there a tax invoice? I say, no, not yet. He says, but did cash flow take place? I say, yeah. He said, well, if cash flow took place, you must account for that. It is income, so it's VAT output. So I have to pay him the VAT. So let's look at an example. ABC enters into a contract to do paving on the premises of XYZ on 10 February 2021 for a total amount of 23,000 Rand. Now, this date is the contract date. ABC requires a 50% upfront deposit before the commencement of the work. XYZ pays the deposit on 14 February and the work commenced on 25 February. On 28 February, the financial year end, the paving was 30% completed. The question is, what accounting entries now? Now, the first thing that happened is that there was a contract. The second thing that happened is there was cash flow. And the third thing that happened that there was income earned. But the cash flow doesn't equal the income earned. Now, let's do a few calculations before we get to the accounting entries. The contract price was 23,000 Rand. That is for this whole thing, for the sole paving exercise that I'm going to do. 23,000 Rand in total. Contract price will include VAT. So what is my first step? My first step is remove the VAT. So what portion of the 23,000 belongs to ABC and what portion of the 23,000 belongs to the receiver? Now, if I take out the VAT, I divide 23,000 by 1.15. The VAT exclusive contract price equals 20,000 Rand. So from that this contract, ABC can only have a maximum of 20,000 Rand worth of income. Now, on the 14th of February, XYZ gave them 50% of 23,000. So they received on this 14th of February an amount of 11,500 Rand from XYZ. The receiver of revenue says, is there a tax invoice? I say, no, not yet. He says, the cash flow takes place. I say, yeah, this guy paid me a deposit of 11,500. Now, this kind of deposit, very important, is a prepayment. It's a down payment on the contract price of 23,000 Rand. So this, we call it a deposit, but it's not a deposit like an Eskom deposit or a municipality deposit that you're going to receive back if you meet certain requirements after a period of time. I'm never going to receive, or XYZ is never going to receive this back because this is a down payment on the contract price. It's important that you make that distinction. Good. He says, they have paid me 11,500 Rand up till now. The receiver of revenue says, so cash flow has taken place, but only to the amount of 11,500. I says, yeah, you've got it. He says, well, then you have to pay me VAT on the 11,500. So therefore, we have to take out the VAT included in the 11,500. So 11,500 divided by 1.15 gives us an amount of 10,000 Rand. So although we received 11,500 Rand, 1,500 Rand of that amount we have to give to the receiver of revenue. So ABC is only going to retain 10,000 Rand of that amount. The rest is the receiver of revenue's money. He says, okay, well, now I've got that picture in my mind, but what now about 28 February? Can I now recognize 10,000 Rand as income in my income statement at 28 February? I says, have you earned 50% of the contract price? I says, well, I don't think so because the work is only 30% completed. That means I've only earned 30% of the price. I've only earned 30% of the total contract price of 20,000. And that is the income I can recognize in my books. So the work done at 28 February is 30% of my portion of the contract price, the VAT exclusive contract price, i.e. the 20,000. So that is 6,000. So before we're going to go to the accounting entries, let's just summarize the information on hand. We have received 50% of the contract price on 14 February. 11,500 cash flows taken place, and we have to pay the receiver of revenue VAT. We have to recognize income at year end, but the maximum we can recognize is only 30% of the contract price, but 30% that belongs to us. We cannot recognize an amount that does not belong to us. No income or expense item in the income statement will ever include that. So on the 14th of February, we have received 11,500. Oops, now with this thing now, it throws it actually over to the next line. We're going to debit bank statement of financial position, 11,500. I'm going to show you this here. Oops. That looks better. That looks better. There you are. We're going to debit bank with the full amount that we've received on the 14th of February, which equals 11,500 Rand. We're going to credit an account that we call income received in advance. We haven't even started putting one paving stone on the ground. So therefore, we are not entitled on anything at this point of time. So income received in advance, statement of financial position credit, 10,000 Rand. And we're going to credit our VAT output, the 1,500 Rand, which is the VAT included in the amount received. We're going to put that to the VAT output against statement of financial position, 1,500 Rand. Then on the 28th of February, it's financial year end, and we're going to recognize income now. And the income we're going to recognize is, as you can recall, 30% of the contract price, i.e. 6,000 Rand. So we're going to debit income received in advance with 6,000 Rand, and we're going to credit sales revenue, statement of profit or loss, 6,000 Rand. So in our income statement, we will have sales of 6,000 Rand. That's it. What will remain in our statement of financial position? In our statement of financial position, income received in advance will be then 4,000 Rand credit balance. So it's a liability. Does that include any VAT? No. So income received in advance will never ever have VAT included in that figure. Why not? Because cash flow has already taken place and we've already paid over the VAT when we received the money, the cash flow. Good, now what about accrued income? Let's do an example of accrued income. ABC plumbers were called out on 28 February at 5 o'clock that afternoon to fix the geyser of Mrs. X. It was an emergency and they responded immediately. Abe, the plumber who went out to fix the geyser, only remembered to tell the admin lady about it on 3 March 2021. The amount of the repairs was 3,450 Rand, and the amount was paid on 10 March 2021, obviously by Mrs. X. What accounting entries will the admin lady pass? The financial year end was 28 February. Is ABC Plumbers entitled on that income at year end? Yes, they are. Why? Because they've already done the work. They just forgot to invoice this person. Now, did cash flow take place? No, but that is fairly irrelevant at this point of time, because on the 3rd of March, she raised the invoice, and based on that invoice, it was paid on the 10th of March. So on 28th February, I'm going to debit an income figure called accrued income. Why not debtors? Because a debtor is originated by a tax invoice, which is posted in my debtors journal. Was a tax invoice raised on the 28th of February? No. Could it have been posted in the debtors journal as the 28th February? No. If it's not in the debtors journal, can I pass it to the debtors control account? Preferably not, because your debtors ledger and your debtors control account is not going to balance. So I will take it to another asset account called accrued income, statement of financial position, the full amount that Mrs. X has to pay for the work done, 3,450 Rand. What can I recognize as revenue, service fee income, statement of profit or loss? Only the VAT exclusive amount of 3,000 Rand. And then I raise the VAT on that VAT output on the credit side, 450 Rand. So what is the impact here on 28 February on my financial statements? I will have an asset of 3,450 Rand. I will have an income, my income statement that I recognize of 3,000 Rand, and I will have a liability as part of my VAT output account, 450 Rand. What happens on the 10th of March when I receive the money? I will receive the full amount from Mrs. X, 3,450 Rand, debit bank, and then I'm going to credit accrued income where I'm going to clean out that account, 3,450 Rand. Okay, are there any questions up to now? Guys, can you see that this is not simple? Can you see why I'm going to be with you now. Can you see why you have to work through this with thoroughly and make sure that you understand what this is all about? Yep, I'm listening.
Sorry, ma'am, I just wanted to ask, when it comes to debtors and the tax, when we often invoice, the debtor obviously owes us the full amount, what we earned as well as the tax. But then we put the tax into, I believe it's tax output when we issue the invoice, correct?
Yeah.
So then when we pay the full tax amount, do we essentially pay the VAT that we owe to SARS before the debtor has given us the money?
Yeah, that unfortunately is so, but the counter leg is also true. I can claim that before I've paid that expense. So effectively, what do? I claim the VAT from the receiver of revenue before my own cash flow has taken place. So in either way, like I said, the receiver of revenue works on the accrual basis. So I have to pay over the VAT as soon as I raise the tax invoice, but I can claim the VAT as soon as I receive a tax invoice or cash flow has taken place, whichever is first.
Okay. Thank you very much, ma'am.
Okay. Okay, guys.
Ma'am, I have a question as well.
Mm-hmm.
I just want to ask, ma'am, why would you have a VAT control account as well as a VAT input and a VAT output account? Why would you have 3 accounts instead of just the 1 control account?
During the VAT period, whether it being a month or 2 months, let's assume it's a 2-month period. It's a small or medium-sized entity. So the VAT period is 2 months. You will have input VAT, a VAT input account where you're going to accumulate all the VAT input, and you will have a VAT output account where you're going to accumulate all the VAT output. So during that 2-month period, there won't be a VAT control account. It's only at the end of the VAT period, which is at the end of the second month, where I'm going to transfer the VAT input accounts balance to the VAT control account and transfer the VAT output accounts balance to the VAT control account. The purpose of that is to determine whether I owe the receiver of revenue money or does he owe me money. And that is the purpose of the VAT control account. That is why I only do that at the end of the VAT period.
All right, thank you, ma'am.
Okay.
Sorry, ma'am, I have a question.
Yes, I listen.
Ma'am, on page 237, there's an example of a debtor settling their debt and they pay 115 Rand. So I understand it's adjustment on the 10th. I understand where the 109 comes from and the 5 Rand, but why do we add 0.75 to the debtor's control account?
I don't know. I have to look at the question. I don't know. I don't know. Send me the question. I'll have a look at it. Okay.
Okay, thank you, ma'am.
Okay, there was a question on the chat box where somebody asked, but what happens is if I have paid over the VAT, I've had a credit sales transaction. So I debited the debtors control account with the full amount. I credit sales with the VAT exclusive amount, and I credit the VAT control account, which I paid over to the receiver of revenue. Now the debtor doesn't pay me. What happens now? Now what happens now is the receiver of revenue says, I'm a very reasonable man. You're going to write off the outstanding debt. So obviously you're going to credit the debtors control account, and that will include VAT because that is what we record in the debtors control account. So you're going to credit the debtors control account with a full original invoiced amount. So you will take out the full balance. You are going to debit a credit losses account, an expense account. You used to call that at school a bad debts account. You don't call it that anymore. It's now credit losses account. You are more sophisticated now. So that's an expense account, and expense accounts is net of VAT. So I take out the VAT, and the VAT exclusive portion will go to the expense account credit losses. And then I claim the VAT back from the receiver of revenue. So let's say, for instance, the outstanding balance was 1,150 Rand on the debtors account. So when I'm going to write off the debt, I'm going to debit credit losses expenses with 1,000 Rand. I'm going to debit VAT input with 150 Rand, and I'm going to create a debtors control account with 1,150 Rand. So effectively, when I write off the outstanding debt, I claim that output VAT back that I've originally paid over to the receiver of revenue. That was all? You understand? Okay. Ooh. Guys, now I can't get back. I don't know how to get back. Minimize. There you are. Good. Any other questions? Yes, Ms. Nkoti, ma'am, when a debtor settles his account, is the amount inclusive of VAT? Yes, when he settles his account, he settles his outstanding balance, and his outstanding balance includes VAT. So what is happening then, I debit bank with the full amount I receive, and I credit the debtor's account with the full amount that I've received. When did I account for the VAT? I accounted for the VAT with a sales transaction, and then I'm done with that. From there on further, I just collect outstanding amounts. Okay. Any other questions, guys? Ma'am, what happens if there are loss of inventory due to fire or flood and the insurance pays? We're going to get to that. When there's a loss, let's say that we had inventory in our warehouse and then we had a fire and all the inventory was destroyed. Now, inventory is in our books at cost, and cost excludes VAT. So basically what we go, let's say there was 10,000 Rand worth of inventory in our warehouse, and that burned down completely. So if we are a VAT vendor and we lodge a claim with an insurance company, The insurance company is going to pay us the 10,000 Rand loss, that was the cost price of the goods that were destroyed, as well as 50% on the 10,000 Rand. So we will receive from the insurer 10,000 Rand plus 15% VAT. But the 15% VAT that we will receive from the insurer, we are going to pay over to the receiver of revenue. So what we're going to retain, only the 10,000 Rand, which equals the amount, the cost price of the goods that was destroyed. But don't break your head about that. We're going to get to that. We're going to do a lot of computations on inventory, so don't worry about that now. Okay. Any other questions? Yeah, there's no VAT implication when the debtor settles his account, because when he settles his account, you have already accounted for the VAT. When did you account for the VAT? When you raised the debtor initially. When you said debit debtors, credit sales, credit VAT. That was when you recorded the sales transaction. When he pays his outstanding debtors, no VAT again. You've already done the VAT. When he pays his outstanding debtors, debit, bank, credit debtors, no VAT. Okay. Same thing with purchases. When do I claim VAT? I debit purchases, I debit input VAT, and I credit creditors. Now I'm going to pay my creditor. What am I going to do? I'm going to credit bank and debit creditors. So when do I raise the VAT? When I do the purchase transaction. So when I record the purchase transaction in my books, that is when I raise the VAT. When I record the sales transaction in my books, that is when I raise the VAT. But when settlement takes place, it's just a payment of an outstanding balance, no VAT. VAT has already been raised. Any other questions, guys? This is an important week. I cannot stress this enough. Your test is up to the end of this week's work, and obviously I'm going to focus a lot on this week's work. And if you haven't done last week's work, you are going to run into problems. Okay. Okay. Good luck. You're welcome to contact me with any problems. Have a safe week.
Thank you, ma'am.
Cheers.
Thank you, ma'am. Thank you, ma'am.
Thank you, ma'am.